Coming up today, the S&P hits a new record, new tariff plans rocking markets, how Canada and Mexico will be affected, the Fed changing their interest rate path, Bitcoin continues its pullback, and all the latest financial news, charts, and memes from today. Let's go, guys. And welcome back to the Daily Market Review, everybody. Bit of mixed trading out there today, led by mega cap tech. Whilst we're getting a bit of a pullback in the small caps, and just looking at the one-day sector performance chart, once again, a lot of dispersion. And what had been soft of late is actually performing a bit better today. Utilities, REITs, and healthcare showing up the top. Whilst we've got energy, small caps, tech and industrials, and financials in the bottom half of the pack. However, the S&P 500 itself just closed at a new record high, 6,021. And just looking at my S&P 500 oscillator indicator down the bottom here, a lot of things goes into this indicator, not just the technicals of the index, but also looks at market breadth, volatility term structure, and a few other things. To identify short-term bottoms and tops in the market, how you should interpret the topping signals slightly different from bottoming signals, like with all oscillators, because there is a strong upward drift in the stock market over time. And so it did give us indication of a bit of a short-term top just a couple of weeks ago. Just got a really small pullback here. And before that, it did give us a pretty good indication back in mid-July, just as it nailed the low in the 5th of August. However, the thing with stocks is they can get overbought and they can stay overbought, and so can this indicator, just like it did in November last year. We had that big push off the bottom, shot up into short-term technical overbought territory, then it kind of just grinded and stayed there. So did the oscillator. And so that's what we call around here walking the line. Stocks can often grind higher like this on low volatility, and that's actually a really bullish signal when you see the oscillator go overbought and stay there. Not only really bullish in the short term, but also medium long term as well. Really bullish short-term price action often bodes well for the medium term. And this indicator can also be used for divergences, just like we saw in the bottom of October last year. So just going back to today, since we were just overbought a few weeks ago and we're already back there, we're either going to see another short-term top, or we could very well grind into the rest of the year. Since this is really a seasonally bullish period going into Christmas, when we're already having a good year, and just looking at my sector trends table indicator, market color is very bullish. Pretty much red everywhere the bulls want to see it. Volatility, bond yields, oil, energy, and inflation expectation, just as sector breadth is as well. Splash of green, showing the majority of stocks are above their moving averages. We've got wide participation in this bull market. That's a healthy sign. And if it feels like a lot of money is coming into the stock market, that's because it is. In fact, 2024 is on track for a record $448 billion. That's almost $500 billion in new money coming into US equity funds. And that can be interpreted in two ways. Some might say it's a sign of a blow off top. However, you could also have said the same thing back in 2013, when that year as well stood head and shoulders above everything else in terms of US equity fund flows. And as we all know, the market continued to rally for years after that. So it's not necessarily a bullish or bearish thing. If anything, it just shows how much liquidity really is out there. And this is at a time when money market funds are at highs as well, above $6 trillion. In other words, there's a lot of cash out there and it all has to find a home somewhere. However, since we are coming into the last month pretty hot, S&P up 24% year to date. That's one of its best performances looking back in history at similar trading periods. Typically for the rest of the year, the market will only on average add another 1%, as it may have got a little ahead of its skis, just speaking technically. However, like I said, I wouldn't be surprised if it does go on for a run here, because there's no real reason for it to have a hard correction at this point in time. I'm sure we'll get a surprise around the corner. Otherwise, everything is pretty bullish for the now. And just looking at the monthly chart of the S&P 500, we're 10% away from hitting 6,600 and going back down to 2009 when the secular bull market started. The market bottomed in March 2009, 666 on the S&P. In other words, we're only 10% off the S&P 500 going up 10x in this secular bull market. And that's not outside historical norms either. This is one of the best secular bull markets. However, some have gone for longer. And remember, there's no hard roof in stocks. There's nothing to stop this secular bull going 12, 13, 15, who knows, potentially 20x. However, just looking at small caps Russell 2000, they're only up about 6x off that March 2009 low. Still got a bit of catching up to do here to the large caps. And that's why as small cap bulls, we're really excited to see yesterday the Russell 2000 break out to a fresh all-time high. Really good technical sign for us there. But just moving on to the biggest story across financial media today and the wide-reaching implications it has across markets. Trump's latest tariff plans. He came out on his social media network today, said he would impose a 25% tariff on all products coming into the States from Canada and Mexico, and an additional 10% tariff on imports from China. So the way I read that is he's currently looking at about a 35% tariff on China. Like I thought, 60% was probably not going to be the figure. It's probably going to be around 30 to 40. However, it's still early days. But he's talking about kicking this off day one with an executive order, using an economic emergency act to get it done straight away. And so this affects everything from stocks, bonds, commodities, currencies, I'll show you in the chart soon some of the reactions we're getting from this. But tariffs are a big deal, and it's going to be more challenging for the rest of the world than it will be for the States. Canada's also in the hot seat. Send a lot of their oil south to the States. 25% tariff from them would certainly be a big deal. They are the world's fourth largest oil producer. And there's a look at the market's reaction today. Looking at the Canada ETF, not a huge move down. Did gap down over 1%. However, market found its ground, just like it did in the Canadian dollar in the currency markets. Dollar shot up versus the Canadian as it weakened, but it too pulled back as well. However, this is just one day. It could still go on for a little while as Canada pretty much exports all of its oil just to the States. And now the new admin really wants to get behind domestic production. So again, this changes the economics of this industry and for Canada as well. And contrary to popular belief, America actually imports more goods from Mexico than China. So if they get hit with 25% tariffs, that's also going to change things quickly overnight. A lot of vehicles and vehicle parts sent into the States are manufactured in Mexico. And that's thanks to a number of trade agreements over the last 30 years or so that pretty much moved manufacturing out of the States into Mexico and China. And that's something Trump has hated for years, and I think a big reason why he got into politics. So he's always had the goal of bringing back manufacturing to America, but other things coming from Mexico, trucks, laptops, also oil, and other hardware and industrial equipment. It's going to get slapped with tariffs at the point of entry into the States. But Mexico's president said his tariffs could lead to retaliation, which, like CNBC host Sarah Eisen says on X today, I'm not sure how much leverage Mexico has over the States, since 83% of its exports go there. And so like we've been saying, these are a negotiating tactic to extract something else from them. With the new president criticizing Mexico and Canada, not to mention China, for facilitating huge amounts of crime, drugs, and illegals coming into the country, saying these tariffs will remain in effect until all of this stops. So coming out straight away playing hardball, and at the end of the day, the states do have the leverage over these countries. And Trump has no problem in enacting that leverage. And just hearing from the new Treasury Secretary today, Scott Bessent, tariffs can't be inflationary because if the price of one thing goes up, unless you give people more money, then they have less money to spend on other things, so there is no net inflation. So he's in full support of them, and he does make a good point here. What really causes inflation is the increase in currency. Just to break it down to a really simple example, imagine a small town of 100 people, and there's just $100 in that town, and there's 100 apples. And those apples are priced at $1. What do you think will happen to them if all of a sudden there's $200 in that town? Things naturally go up. And that's what we've seen over the last couple of years. Record amount of government spending and new liquidity created by the Federal Reserve. Inflation was always going to go up after those two things. And he's looking to do a 3x3 policy, cut the budget deficit to 3% of GDP, spur 3% GDP growth, deregulation, and produce an additional 3 million barrels of oil a day. As that's a key part of economic growth for him, getting the cost of oil down. Which in addition to a huge structural tailwind coming from the country's leaders, in addition to that, artificial intelligence could help bring the cost of extracting oil out of the ground down as well, as drillers are becoming increasingly more efficient as new technology takes hold. And so this again could be another long-term trend. And why I definitely wouldn't rule out seeing crude oil in the 50s next year, who knows, potentially high 40s again. AI is touching every industry and unlocking new productivity and efficiency gains that just haven't been possible before. So like I've been saying lately, if you're in the market for electronics, anything else that's typically imported, may not be a bad time to buy the dip than Black Friday or any other sales over the coming month. Maybe a new washing machine, anything for the kitchen, laptop could go up, refrigerator, all these type of items could very well go up in cost come Q1, Q2. So Canada, Mexico, China, they're all in the firing line. I'm sure a few others are as well. However, who should be okay? And it certainly helps when you're good friends with the 47th president, not to mention the world's richest man, Javier Milei, and the fantastic job he's doing in rejuvenating Argentina. After decades of socialism, pulled the country into the ground, he kind of laid out a template that the states is looking to follow as well. Drastic cuts to government spending, removing government departments, loosening up regulation, and letting entrepreneurs drive the economy to create wealth. Because remember, governments only spend wealth, they don't create it. And capital markets are noticing. Argentina, the best performing stock market in the world this year, up over 60%. Milei only came into office December last year. Market loved it straight away, and it's just been on an absolute tear since then. And just looking at fund flows into the Global X Argentina ETF here, just going out all-time chart here. Look at that. Big money is coming back in. A year ago, this fund had $50 million assets under management. It's gone up more than 10x, especially the last couple of months. Institutional money is coming back in. And that's because Javier Milei has boosted investor confidence in his country. And I can share with you guys today one of my Argentinian stocks I'm invested in, listed as an ADR in New York, Grupo Superviel, a bank, which I bought for my StockPicks account back in August. It's already up over 60%, just had another great earnings, and believe it or not, the price to earnings ratio is still just above 5. And just going out to a monthly chart, you can see how hard it was whacked after peaking out in 2018. It's done a nice bounce here, absolutely ripped off the bottom and could still have further to go. I've also got another Argentine stock in the portfolio, but out of respect for paying members, I'll keep that discreet. But for anybody who wants to join my stock pick service, you can also use the code SWING33 to get a permanent 33% discount off my stock pick service. Send out a new stock every Sunday that I'm about to buy my account the next day. And for anybody who would like to get my stock picks and my new swing trading alert service, then head on over to the packages page. You can also use the coupon code SWING33 to get a 33% discount off a package deal. And available spots are filling up quick. Currently got 74 left as I speak, which I think will be all gone at some point this week. And so if you don't want to watch me grow these new trading accounts on the sideline and you want to join in on our journey to Vegas with a $1 million trading account, then click the link below this video, head on over to my website, clickcapital.io, and secure your spot today. We've been having a great year in the markets, and next year is shaping up to be another good one as well. But just getting back to the daily market review, we just got Fed minutes today, with Fed officials actually becoming more confident about the jobs market now. A couple of months ago, they weren't so sure. However, today they have more confidence that everything's okay, and they're slowly changing their tune from being worried about the downside risks to the upside risks, and starting to show that they're more cautious on further rate cuts, starting to keep an eye on inflation now, which we'll get a taste of tomorrow when we get PCE data, expected to come in 2.8% year over year. And we're still tracking the similarities between CPI from the 70s and today here in the green, as the Fed made the mistake back in the mid-70s as well, started cutting rates, helped a big resurgence in inflation. There are key differences between back then and now. The Middle East had a lot more leverage over the States back then with exporting oil, and with an oil embargo, it set off a lot of inflation, especially at the pump. And so as an investor, the best way to insulate yourself from inflation is to own assets that benefit from it, with my personal choice being commodity stocks, which also did really well back in the 1970s. While non-commodity energy stocks actually had a hard time. It was a lost decade for the S&P 500. But again, as of now, the market actually has about the same inflation expectations as it did the day before the election. So for the here and now, inflation is still okay. However, there definitely are upside risks out there. Again, the world's awash with currency and liquidity. Everything that's been created over the last 4 years just doesn't go away overnight. What happened with COVID could have ripple effects that last decades, as it was such an extraordinary event. Even more extraordinary, the overcompensation and overstimulation from the government and Federal Reserve in response to the panic. And that's because those policymakers, just like markets, often overreact in the heat of the moment, which Jay Powell knows he did, he'll just never admit to. Cooling off a little bit is real estate. House price gains are slowing. This is pretty much a story in all Western real estate markets. We've got inventory building up, high rates still biting a lot in the industry, real estate agents having a hard time moving inventory, and of course there's pockets in all of our countries, some doing better, some doing worse. But new home sales in the States did plunge to a 2-year low. Obviously the hurricanes skewed that data. But the biggest thing is most Americans are locked in to low rates on their mortgages. So if they were to sell and reborrow, they'd come back in at current day rates, which are a lot higher. Obviously, a lot of people don't want to do that. But that's the unique setup in real estate. Overall, as we just saw again today, consumer confidence jumping to a 16-month high. On the whole, Americans are feeling a bit better, a bit more optimistic. Price of gas is coming down. Most people got the outcome they desired from the election. And overall, the jobs market is holding up. Unemployment at 4.3 is still pretty low. Geopolitics has been another story that had been presenting some risks. However, we're just getting news. Israel approves a ceasefire deal with Hezbollah aimed at ending the Lebanon conflict. Obviously, we could still see a tit for tat between Iran and Israel. However, the new admin's agenda is to negotiate a deal with Ukraine and Russia. And so as investors, and I guess also as global citizens, we're all hoping to see geopolitics and the risk of World War III subsiding over the coming months and years. And America already at record production, that too could also accelerate. Further taking share away from OPEC, who would most definitely like the price of oil a little bit higher than where it is at the moment. And there's a look at crude, once again bumping around, been consolidating for a few months here. And the more we keep pushing against this key support zone, the more likely it is to break. You could think of asset prices every time they push against a key zone, it kind of weakens it. And so like I said, I wouldn't be surprised to see crude lose this big key support zone, simply because of the supply side. Even if China comes back with demand, the world's so flush with supply that it could very well indeed overwhelm demand going into 25. However, there's a much different story for other commodities, and what I call commodities of the future, helping the electrification of the world. Silver being one of them, as many companies are finding new ways to use it as part of renewable energy technologies, batteries. It also plays a role in electronics. People like to hold it in their hand, wear it on themselves as jewelry, and there's many other industrial applications of silver as well. And the market's already in a supply deficit, demand already exceeding supply, and this could accelerate as well. Just like the demand for electricity electricity, uranium, lithium, nickel, copper, and other commodities that are a part of electrification and the push towards renewable energy. And there's a look at silver futures pulling back a little bit over the last month and it's going out to a weekly chart, still in a well-defined uptrend here, but it's going out even further to a 3-month chart. Unlike gold, still well off those all-time highs. So I still think silver has the potential to take out those previous highs and could still be in a bull market for many more years to come. And unlike silver and other commodities that have real life applications, the hottest asset of the day does not. Bitcoin continuing its pullback after coming within an inch of the psychologically important $100,000 milestone. Did the whales already step in there and start offloading as everyone was certain it was about to hit 100K? Or is this just a little pullback before it goes on to $13 million a coin, like some people out there want it to do? And does anybody really think the world's going to be better off if Bitcoin's $13 million a coin? There's just as much value in crypto as there is in global equity and real estate? Well, apparently a lot of people do, including companies. Video platform Rumble planning to buy 20 million of Bitcoin in the new treasury strategy. More and more companies, especially smaller ones now, trying to replicate what MicroStrategy is doing. MicroStrategy was historically enterprise software business. However, now they aggressively buy Bitcoin by selling bonds to the market. And since it's working so well, why doesn't half the S&P 500 start doing this? But like I said, what does it do to the world and the pace of innovation if all these billions of dollars that could be put towards creating new technology and other innovations for the world that actually make our lives better, but are instead just being hodled in Bitcoin, hoping more people buy it on top of you, so it continues going up in price. But just looking at some interesting data today, crypto's fear and greed index was just a few days ago as high as it can be. I mean, the market had been as enthusiastic as it ever was. Also got an interesting correlation between global M2 money supply, kind of think of that as global liquidity, cash, saving, checking accounts, money market funds, with this chart here pointing out that Bitcoin lags global M2 by 10 weeks, and M2 has actually been pointing down the last couple of months. We did have that big explosion in liquidity, however that's pulled back. And Kramer did say when Bitcoin was 99,000, just buy it, it's a no-brainer. The classic Kramer contrarian indicator, as he pretty much represents peak sentiment. And as we've seen time and time before again in history, the crowd can be wrong. However, technically speaking, this is just a small little multi-day pullback. There's been no signs of big selling. However, I would say there's a lot of hot money in here, levered up, and that's how it kind of feeds onto itself. When you get those big red candles, people are getting margin called, a lot of people start freaking out and they start selling. And that's how you get that capitulation. And just looking at MicroStrategy, who bought another 5.4 billion worth of Bitcoin yesterday, fell 12.3% today. And just measuring from last Wednesday's high to today's low, stock already pulled back 37.5% over the last 4 trading sessions. And that just goes to show you how levered to the gills this thing is. You can imagine when it does crash, it'll be one for the ages. In my opinion, a better way to gain exposure to crypto for those that must have exposure to it is through a stock like Coinbase Global, the biggest regulated crypto exchange in the States. Partnering with the US government, CEO Brian Armstrong actually met with Trump. And it still gives you exposure to Bitcoin, but without all the shenanigans that MicroStrategy is engaging in and the risks that they ultimately present to equity and bondholders, in my opinion. Coinbase got a market cap 73 billion. MicroStrategy just reached 100 billion. And so I kind of think of Coinbase as like the blue chip stock when it comes to crypto. But it too has very high volatility. And it's also interesting to note that the second largest crypto, Ethereum, is still well off all-time highs. And just like many other cryptos, they haven't broken out to all-time highs. We don't have the best crypto market breadth out there. It's really been Bitcoin just smashing up high here. But of course, all-time highs is definitely a bullish thing. But once again, it's just so hard to value. I myself prefer to keep the vast majority of my wealth in cash flow producing assets. And even though that's difficult, at least you've got a starting point to do some relative valuations. And I have seen Bitcoin valuation models, but in my opinion, they border on fantasy. Because without tangible assets and cash flows, in my opinion, it's near impossible on how to assign a fair value to an asset like Bitcoin. But nonetheless, it's certainly got the attention of millions of investors and traders all around the world, and certainly entertaining to follow, that's for sure. And so I guess we'll just have to wait to see if Kramer's famous call just below 100,000 turns out to be correct, or maybe not. Otherwise, just getting back to the stock market, like I said, it was really mega cap tech leading the charge today. Nice bounce there for Microsoft, up 2.2%. Amazon as well, up over 3%, with Apple actually pushing up against all-time highs here, even though they had a pretty bad miss in their last earnings. Jury's still out on the iPhone 16. Market appears to be warming up to them somewhat here. And Tesla as well, still consolidating below this big key resistance zone of its all-time highs. And the VIX continuing its pullback, now down in the low 14s. So looking at option and bond markets, things are pretty chill and calm for now. Market breadth is pretty good across the board. Unless we get no real surprises, market looks to be on firm footing going into the holiday period. That's all for the daily market review today. Thanks very much for tuning in. And like I said, anybody who wants to jump on board and get all my swing trading alerts before I trade them, now is your chance, because in a few days, this will be gone and I'll be closing it to new subscribers. Thanks very much, guys, and I'll see you again tomorrow. Cheers.